Today we're analysing Ali Invest.
The company was a car loan operation for 90 years. Then it loaded up on subprime mortgage securities, nearly collapsed and required $17.2 billion in government bailout money. The taxpayer owned nearly 74% of it. The company rebranded, launched an online bank promising to do right by its customers, acquired a beloved independent broker for $275 million and renamed it. Today, it sweeps uninvested brokerage cash into a program paying 0%, while the savings account in the same login pays 3.5%. In October 2025, the financial industry regulator fined the brokerage $850,000 for destroying 22.6 million business communications that were unavailable for 39 separate regulatory inquiries. A data breach in 2025 exposed 4.2 million customers. The bank that built its brand on doing right has a complicated relationship with that promise. The original company was created in 1919 so that a car manufacturer could sell more vehicles. Most Americans could not afford to buy a car outright. The solution was installment financing. The lending arm existed for one reason: move cars off the lot. For 90 years, the entire business was auto loans. Then in the early 2000s, the company expanded aggressively into mortgage banking. When the subprime market was growing, that expansion looked like smart diversification. When the market collapsed, it became an existential threat. The government intervened with $17.2 billion in bailout funds. At its peak, the taxpayer owned nearly 3/4 of the company. A car loan operation was now majority owned by the American public. The government eventually recovered approximately $19.6 billion, turning a small profit. The company rebranded in 2010 to escape the association with both the car manufacturer's bankruptcy and its own near death. The new name was chosen to suggest partnership. The marketing campaign that followed promised to do right by the customer. That same year, a $100 million discrimination settlement landed. The auto loan pricing system had allowed dealers to charge minority borrowers higher rates than comparable white borrowers. 235,000 people were affected. The brand promising to do right launched against that backdrop. The online bank attracted a loyal following among savers who wanted more than what traditional banks offered. No branches, no minimums. Higher interest rates passed to customers from the overhead savings. In 2016, the company acquired an independent retail broker called TradeKing for $275 million and renamed it Ali Invest. TradeKing had been known for low commissions, strong options tools, and a community that respected its traders. What the community gained was banking integration. What it lost was its independent identity, the community forums that traders had built around the platform, and the sense that the broker existed for traders rather than as a retention tool for a bank. The acquisition logic was clear. Millions of banking customers keeping money in savings accounts could be offered a brokerage within the same ecosystem, increasing how much each customer was worth over time. Ali Invest offers commission-free stock and fund trades with an options commission that undercuts the three largest competitors. The exercise and assignment fees on options are zero. The margin rate at the base tier is over 11%, which matches the industry but is not competitive against specialists. There is no futures trading, no cryptocurrency access, no paper trading, and no advanced charting that competes with the platforms offered by the legacy brokers in this series. The cash sweep is the number that matters most. Uninvested brokerage cash is moved into a deposit program paying approximately 0%. The same customer in the same login can open a savings account at the parent bank paying 3.5%. On $100,000 in uninvested cash, that is the difference between earning nothing and earning $3,500 a year. The company earns net interest margin on those swept deposits. If the cash went into the savings account instead, the customer would earn more, but the company's margin would shrink. The arrangement maximizes the company's interest income at the expense of customer yield. The securities regulator has fined competitors for the same structure. The automated portfolio product comes in two versions. The free version holds 30% in cash. Over a decade on $100,000 invested, the drag from that 30% cash allocation compared to a fully invested portfolio costs approximately $46,000 in foregone returns during a typical growth market. The paid version charges 0.33% annually with roughly 2% in cash, which is competitive with other automated advisors. One account holder reported their balance showing zero for 3 to 4 months, despite holding securities. A 1.5-hour call failed to resolve it. Another reported a 50,000 daily transfer limit, blocking larger withdrawals from the investment account. When accounts are locked, the pattern is the same as every platform in this series. The money is inaccessible until someone on the other end decides it is not. The financial industry regulator fined the brokerage $850,000 in October 2025 for destroying 22.6 million business communications across 6 years. 500,000 additional communications were received but never reviewed as required by supervisory procedures. The destroyed records were subsequently unavailable when 39 separate regulatory inquiries requested them. 39 investigations that may have reached different conclusions with complete documentation. The record-keeping requirement exists specifically to enable regulatory oversight. Destroying the records does not just violate a technical rule, it actively prevents the regulators from identifying other problems. The parent company's data breach in 2025 exposed the personal and financial information of 4.2 million customers. A class action lawsuit was filed. Because the brokerage and the bank share the same login ecosystem, any breach of the authentication system affects investment account security simultaneously. The same credentials that access your savings account access your portfolio. The auto lending business that has defined the company for over a century continues to drive its financial health. Rising credit losses from used car loan defaults have pressured the parent's earnings. The stock fell approximately 11% in early 2026. A financially stressed parent company may be less inclined to invest in the brokerage platform. The transfer out fee is $50 for a standard account, and the retirement account closure fee is $25. Both are charges that the largest competitors either match or waive entirely. Ali Invest, for anyone who already banks with the parent institution and values the seamless integration between savings and investing, where instant transfers between accounts in the same login offer a convenience advantage no standalone broker can match, where the options commission undercuts the 3 largest competitors, where exercise and assignment fees are zero, and where the free automated portfolio product serves investors who accept a 30% cash allocation, accepting that the cash sweep pays 0%, while the savings account in the same login pays 3.5%. That 22.6 million business communications were destroyed across 6 years, leaving 39 regulatory inquiries without the records they needed, that 4.2 million customers were exposed in a data breach, that the parent company was built as a car loan operation, required $17.2 billion in taxpayer money to survive, settled $100 million in auto lending discrimination charges while launching a brand built on doing right, and that the brokerage was acquired not to serve traders, but to keep banking customers from leaving. The integration works. The question is whether the institution behind it has earned the trust the integration requires. Every choice is a trade-off. At least now you know what you're trading.